What if I told you that $5,000 a month showing up in your bank account without you working for it isn't some fantasy for retirees or trust fund kids? It's actually just math. Slightly boring, very achievable math. Okay, here's the question everyone asks eventually. Maybe after a bad day at the office. Maybe after seeing a colleague retire early. How much money would I actually need sitting in investments to earn $5,000 a month in dividends alone? Most people guess wildly. Some say $1 million. Some say 10 million. The real number might surprise you, in both directions. Let's start where you probably are right now. You wake up. MRT is packed as usual. You get to the office, you work hard, and at the end of the month, your salary lands. Some goes to rent or your HDB mortgage. Some goes to CPF. Some goes to that gopi you buy every single morning without thinking twice about it. And whatever's left, if anything, maybe goes into a savings account earning basically nothing. That's the loop. Work, spend, save a little, repeat. And somewhere in the back of your mind, there's this quiet question. Is this just it? Am I trading my time for money forever? Here's the big idea, and it's simpler than most finance channels make it sound. Dividend investing flips the relationship. Instead of you working for money, your money starts working for you. You buy a small piece of a business or a basket of businesses, and as those businesses make profit, they pay you a slice of it, regularly. Whether you're sleeping, whether you're at Sentosa, whether you're stuck on the north-south line at rush hour. So, the real question isn't should I invest, it's how much do I need, and how do I get there without waiting until I'm 80? Let's do the actual math right here. Most Singapore-listed dividend stocks and REITs, think banks, industrial REITs, some blue chips, yield somewhere between 4 and 6% a year. Let's use 5% because it's a nice, realistic middle ground, not overly optimistic, not overly conservative. To get $5,000 a month in dividends, you need $60,000 a year in dividends. At a 5% yield, that means you'd need a portfolio worth $1.2 million. Okay, take a breath. I know what you're thinking. So it is the $1 million answer. Kind of. But here's where most videos stop and where the real story actually begins. Because nobody wakes up one day with $1.2 million sitting around. Nobody. Even the wealthiest people you know built that number slowly, brick by brick. The question was never, do I have $1.2 million? The real question is, how do I build toward it, starting from where I actually am? This is where most people quietly give up. They see the big number, feel discouraged, and go back to their Kopi and their Netflix. But here's something interesting. The number doesn't matter nearly as much as the mechanism. Let's talk about the mechanism. Imagine planting a small tree in your backyard. In year 1, it looks almost identical to how it started, maybe a little taller. Boring, honestly. You'd be forgiven for thinking nothing's happening. But underground, the roots are spreading, quietly, invisibly. And then somewhere around year 7, 8, 10, that tree suddenly shoots up faster than you expected, and people start asking how it grew so fast. That's compounding. That's what happens when your dividends get reinvested instead of spent. Each payout buys a few more shares. Those new shares generate their own dividends next quarter, which buy more shares. It sounds small. It is small at first. Let's say you start with $10,000 and you add $1,000 every single month into a diversified basket of dividend-paying stocks and REITs, averaging that same 5% yield with dividends reinvested. Nothing exotic, nothing risky, just consistency. After 10 years, you're not just looking at what you put in, roughly $130,000 in contributions. Reinvested growth pushes that closer to $170,000 to $190,000, depending on market conditions. Still a long way from $1.2 million, sure, but here's the part that changes everything. After 20 years, that same habit, same $1,000 a month, same reinvestment, puts you somewhere in the range of $450,000 to $500,000. And after 25 to 30 years, with the snowball fully rolling, you're realistically looking at crossing that $1 million to $1.2 million mark. Now, 30 years might sound like forever when you're 28 and just trying to survive till payday. But here's the thing most people miss. You're going to live through those 30 years regardless. The only real decision is whether you spend them building something or whether you spend them starting from zero, again and again, every single year. But wait, here's where most people completely misunderstand this part. You don't actually need $1.2 million to feel the effects of this strategy. You don't need to hit $5,000 a month on day one for this to change your life. Because somewhere around year 15, when your portfolio is throwing off $1,000, $1,500 a month, that's not retired tomorrow money, but it's rent money. It's your kids' tuition money. It's the buffer that means a job loss doesn't turn into a crisis. It's optionality. And honestly, that's worth more than the headline number. Let's change the perspective for a second. Instead of asking, when will I hit $5,000 a month, ask, what would an extra $500 a month mean for me right now? For a lot of Singaporeans, that's a mortgage payment. That's your kids' enrichment classes. That's the difference between dreading your CPF statement and actually feeling okay about it. There's another reason this matters more than people think. Singapore has one of the highest costs of living in the world, but it also has something most countries don't: a genuinely stable, well-regulated market to build wealth in. Between CPF, SRS, and a liquid stock market with real dividend-paying companies, the infrastructure already exists. Most people just never use it. Now, here's a mistake worth avoiding: chasing the highest yield you can find. Some counters advertise 8, 9, even 11% yields, and sure, some of those are legitimate, but often an unusually high yield is the market quietly telling you something's wrong: declining business, unsustainable payout, or a share price that's crashed for a reason. A steady 5% from a diversified, well-run REIT or blue-chip bank is worth infinitely more than a flashy 11% that gets cut in half next year. This is where most people stop watching finance content and just do nothing. Don't be that person. Here's what actually moves the needle. Start small, but start now. Even $200 or $300 a month invested consistently into a diversified dividend portfolio beats waiting until you have enough to start properly, because there's no such thing as enough, there's only starting. Reinvest every dividend for as long as you possibly can. Don't touch the payouts. Let that tree grow its roots quietly for the first 10 years, even when it looks like nothing's happening. And increase your contributions as your salary grows. If you get a raise, a bonus, a promotion, before your lifestyle expands to match it, let your investing amount expand first. That single habit, more than any stock pick, is what separates people who hit their number and people who don't. So, $1.2 million to earn $5,000 a month passively. That's the honest number, not a scary number, not an unreachable one, just a destination that gets closer every single month you choose to plant instead of spend. The payslip you get this month doesn't decide your financial future. The decision you make about what happens to the leftover $300 or $500 does. And the best time to start that tree growing was years ago. The second best time is this month.